Hey guys, Greg Silverman, CIOs and Bowties, coming to you from the Starship Enterprise, the deck of, with some interesting news items from the last week or so. Let's really begin. Jump in. US pot legislation suddenly seems more likely. It deals with the fact that Biden is basically being less disposed towards legalization, but the article deals with the fact that he may be pressured by the left of the Democratic Party to enact legalization if he were to win. So they talk about the Democrats winning in the White House, winning in the Senate. The route they potentially could take is decriminalization at the federal level and then allowing full legalization at the state level. The article talks about basically it cites social unrest, criminal justice reform as really the argument that the left will be pushing for full legalization and certainly allowing the minorities who've really suffered around social injustice, social unrest to participate in cannabis businesses. So interesting article there. The next article, commercial mortgage delinquencies near record levels. They've actually come off record levels as the stimulus has and the Fed Reserve actions have really bolstered that market. But at some point it talks about the CMBSs for hotels and accommodation. The occupancies are expected to level off at about 41% compared to where they were before. Retail's about 18 billion CMBS, of which about 18 billion distressed, 11.4 billion is bankrupt JC Penney. Multifamily has really hung in there. Stimulus certainly helped on the rent checks for the lower demographic. So the future does look a little uncertain though, although it is a necessity. Industrials have been the all-out winners. E-commerce, of course, has been the winner during the coronavirus, as has warehousing and logistics. Geographically, all the big money centers have really been the ones to suffer. The CMBS is located in that area. New York, Minneapolis, LA, Chicago. So no surprise that we're seeing exodus from some of those metropolitan areas. Real estate, again, the CARES Act handed commercial real estate the three tax benefits. First of all, net operating losses. So the Tax Cut Jobs Act of 2017 limited net operating losses to 80%, and you could only offset future profits, not backdated previous years. The CARES Act allowed you to now write off net operating losses going back 5 years. So basically, in certain instances, it created an instant refund for some real estate companies, and they could recoup tax immediately. So the IRS is expecting a big flood of refunds resulting in that. Secondly, qualified improvement to properties. Tax Cut Jobs Act allowed a $10 million accelerated depreciation. So, listen, this is the Congress, right? When they came to write the bill, they forgot to put it in the bill, and the bill was written that it was only written off over 39 years. Partisan politics, they didn't want to come back and pick it and fix it, but they eventually came back in the CARES Act and they have fixed that up. This is for commercial non-residential property. If you've made a $10 million improvement, you can basically write it off that year. So that's a huge bonus. Then lastly, the interest expense limitation. The Tax Cut and Jobs Act again capped net interest expense. That was painful for highly leveraged real estate, of course. Now, you could have made an election as to whether you wanted to cap your interest expense or you wanted to use your qualified improvement accelerated depreciation. The CARES Act has allowed you to change your election for 2018 and 19. So you can go back and see whether it was better to use the qualified improvement protection depreciation or to cap your expense, and then you can make the election going forward. So you're getting the best of both worlds, and it's very unusual for the IRS to allow you to change an election in the past. It's all based on the holding period of the property, and so there's a lot of combinations. But commercial real estate, non-residential, certainly has benefited immensely from the CARES Act. I'm not sure that's showing up certainly in some of the REITs. Okay, the last one is an interesting article, I believe. It talks about buying stocks trading above 10 times sales. Is that a good idea? And if there's ever been one for data mining, I believe this is the article. But let me tell you about it. Jack Bogle, PhD, he created a universe consisting mostly of 10 times price to sales stocks and then compared it to the Russell 1000. Performance over 1 year, 16% versus Russell 9.3%. 3 years, 21% versus 13.5%. 5 years, 16% versus 10.6%. No surprise what made it into the 10 times sales universe, mostly tech, biotech such as Visa, Netflix, Adobe, Illumina. So is it a good idea? I would say this is quintessential data mining, factor mining. Yes, growth has been outrageously fantastic, and growth is normally higher multiple, higher price to sales stocks. So will it work in the future? I have no idea, but it certainly worked in the past. So watch out for those factor minings. Okay, guys, that's it from the Starship Enterprise. Greg Silverman, CIOs and Bowties, out.